Please type yes if you can see my new screen. So we can start. Okay, so I think you can see my new screen, so we can get started. Okay, so like I was saying, today's topic is about we are going to look at the importance of highs and lows. Now, what do I mean by highs and lows? It's pretty simple. Before I explain exactly what I'm talking about, there's something else I have to talk about briefly. Okay, now the highs and lows are simply showing you how high the market has traded within a particular period and how low it has traded within that period. So it's basically showing you the highest price, specifically the highest the market traded within that period, and then the low is referring to the lowest the market traded within that same period. Okay, now this market, if you look at the charts as I am showing you right now, you realize that we have two axes. We have the y-axis and the x-axis. For those of you who did mathematics, you know what I'm talking about. But this is not what you did in school. I'm just going to use it as a reference point. What I'm referring to as the y-axis and the x-axis, if you look at this horizontal part of my screen, sorry, this vertical part of my screen where I have the cursor right now on the MT4 platform, you can see certain prices. This is USD CHF. That is the Swiss franc against the that's a US dollar against the Swiss franc. So if you look at where the cursor is, the vertical scale, you will see prices. Then if you look at where it is right now, the horizontal scale, you will see dates or time. Do you get me? So a lot of the time, the mistake most traders make is that they concentrate on price, but they never include the element of time in their analysis. You have to look at both time and price, because if you look at the chart as I'm just showing you, you realize that we have a vertical axis that is made up of price, and then a horizontal axis that is made up of time. So you have to consider both factors when you are doing your analysis. So if you look at my screen, you can see dotted vertical lines. And from one vertical line to the other is representing a particular period. Right now I'm on the daily time frame. So if you look at my chart from one vertical line to the other, is representing 1 month's price action. These vertical lines you are looking at are referred to as period separators. Now they have a very important role they play in price and time analysis. Okay, so like I was saying, the highs show you how high the market has traded within a certain period, and the lows show you how low the market has traded within a certain period. That is what I mean by highs and lows. So the highest price and the lowest price. Now, why are these prices so important? It's a business we are doing over here. This is not a game. This is not some scheme that you can just come in and then do whatever you like. It is a very well-structured business. And all we do over here is buy and sell. We're either buying or selling, depending on what conditions the market is presenting us with. Now, since we are buying and selling, it is very, very important that you consider highest price and lowest price in your transactions. So the highest and lowest prices can be used as support and resistance levels. Now, for those of you who don't know what a support level is, I'm saying this because I know that there are beginners amongst us. The support levels are certain levels on the chart where the market is very likely to move up from. So we usually look for support levels to buy, and then we have resistance levels, which are levels where the market is very, very likely to sell away from. So we look at support levels to buy and resistance levels to sell. That is basically what it is. So the highs and lows can act as support and resistance level. We are going to look at a couple of examples and what it means whenever the market trades above a particular high or trades below a particular low. Okay. So let's do some little analysis here. Now, let's look at what happened last month. This is USD CHF. Let me zoom in so you can see what I'm talking about. Now, like I would say, this is a daily time frame. And so from one vertical line to the other represents 1 month's price action. So for USD CHF, this was what happened in the month of January. That was last month. From this level all the way to that level. So now that is a period. So the question now becomes, how high did USD CHF trade in the month of January? Now, if you look at the charts, this was where the whole thing started from. The move usually starts right on the vertical line. So for the month of January, this was where the whole thing started, where I have placed a horizontal line, the red vertical line. That was where it started. Where did it end? This was where it ended, right on that candle. And February began right on the opening of the next vertical line. Okay. So this was what happened within the month of February. So I'm going to highlight whatever happened in February and then now explain to you the importance of highs and lows and why you must consider them in your analysis. So let me highlight it. So this was what happened in the month of January. That was just last month. That is the area we are looking at. Remember, it's a daily time frame, and on the daily time frame, from one vertical line to the other, which are period separated, represents 1 month's price action. So in the month of January, this was how high the market traded. Let me place a horizontal line there. And this was how low it traded. That was for the month of January. So what happened? Now, when February began, the market traded above January's highs. Now, why are these highs so important? They are important because they are always acting as areas of what we refer to as a draw on liquidity. So if the market trades above a particular high, then it is suggesting something to you. So this is a trade I called in the platform I was talking about. I asked them to sell it. Why? We already sold from here, from this point. From here. And then we sold again here. We closed these old positions and then we sold again. So now let me explain why these highs are so important. The highs are acting as areas of what we refer to as a draw on liquidity. And so when the market trades above such a level, it is suggesting something to us. Now, we usually want to look out for what is hanging above those levels. Do you get me? Now, if I look to the very left of the chart, I see what we refer to as an institutional candle right here. So looking at that level where we have the institutional candle, we usually wait for an old high to be taken out and then trade into that level of institutional candle and then we sell from there. So this was what we sold USD from right there. So imagine entering this trade at this very position. That's a very good setup, a very good entry, and that is very good money. Okay. So like I was saying, these highs are acting as resistance and the lows are acting as support, more or less. Okay, so if you look at what happened over here, after the market traded above that high, this way, it came back to do a retest of it. That is traded right back to touch that line. But it was not a perfect retest because the market moved down further before it started to go up like this. It moved all the way down to this level before it went back up. Okay, so I want you to see these highs as what we refer to as a draw on liquidity. A draw on liquidity. So usually what I tell the people that I teach is that you should pay attention to what is happening at the highs, but what you should pay more attention to is what is resting above those highs. So if the market closes above the high, for those of you who know what an order block is, that is what I was referring to as an institutional candle. Okay, the market trades above these old highs and then trades right into that order block. That is a sell confirmation right there. Sell from there and you make good money. Let me show you other examples. Now let's look at what's happening for the month of February. We are currently in the month of February. Let's look at what is happening. Let me get rid of these rectangles so we start. Let me highlight it. Now for the month of February, this is how low the market has traded so far. And this is how high. The month is not over yet. So it's possible that it could come down to take out this old low and create a new low for the month. Or it could go up to take out this old high and create a new high for the month. It is possible. Because the month is not over. Today is 18. We still have about how many more days? We still have about 10 days for the month to end. Anything can happen within that time. So this is a high for the month of what do you call it? February, and this is a low. So if I want to trade this pair, I'm going to be looking at these highs and lows as my range. Because I've established that this is how high it traded and this is how low it traded. Now, if the market happens to come back up, okay, and trade above this high, which is acting as a resistance level, it is very likely to come back this way, test it, and then do what? Continue going up. Because that level is acting as a resistance level, that is what? Broken. But as to whether it will go up to clear that high and then retest and continue going further up will depend on the overall trend of the market. But that looks unlikely because if you look at USD CHF for the bigger time frame, it is very, very bearish. So we've seen some short-term bullishness recently, but that bullishness appears to be just a retracement. Long term, it looks very bearish. And because it looks very bearish long term, this is unlikely for the market to trade above this high and then retest and continue trading higher. This is what is actually more likely because of how bearish the market is. Let me show you. We could see the market do this. Trade below this low, which is acting as a support level. Now, if you happen to trade below that low, that is a support level broken. So it becomes a flip zone. Flip zone means a support level turned resistance or a resistance level turned support. In this example, it's a support level. So if the market happens to come down to trade below the support level, it's likely to go back up to retest it and then continue selling like this. So that's the range. That is the range. So if the market happens to trade above this high, then I know what to do. If it trades below this low, I know what to do as well because I've already established the range. That is the importance of highs and lows. But like I was saying, if you want to know which of the levels the market is likely to go up to take or come down to take, you always have to look at the trend on a bigger time frame. And what time frame am I referring to? I like to look at trends on the monthly time frame because that is a really big time frame that can tell me what the market is actually planning to do. So if you go to the monthly time frame, you can see that this pair has been selling since last year. That has been selling since 2019. It has been selling for a very long time. You can clearly see that this is a bearish market. For those of you who use trend lines, you can see the trend line phantom. You can see that it is a descending trend line. Do you get me? It means that the market is trading lower. So it's a very bearish market. So I am looking out for more sell opportunities on this pair rather than buy opportunities because of how bearish it is. So if I come back to the daily time frame, the monthly time frame is too big a time frame. You cannot place trades there as a retail trader. You don't have it. You need to have very big capital, like a bank or an institution, to trade on such big time frames that you can hold your trades for a very long time. As a retail trader, you should be targeting relatively smaller time frames. So you could tell from the monthly time frame that this is a very bearish market. And so this is more likely to happen. The market trading below this old low, which happens to be the low for the month of January, come back up to retest it, and then continue trading lower. This is more likely to happen based on the trend of the market. So this is what we are looking out for. Let's look at other examples. By going back, by going further back. Okay. I'm looking for a very good example to explain something to you guys. I saw some pretty nice examples in gold. Let's look at gold. This is gold. This is one of my favorite assets. I trade it very often because it moves very quick. It can give me sharp money. Yeah, I love how it moves. Okay, so let's look at what gold did, what it has done so far this week. Now I'm currently on the 4-hour time frame. Now on the 4-hour time frame, from one vertical line that represents 1 week's price action. So this was what happened last week. This is last week's price action. Last week, one vertical line to the other represents 1 week's price action. So once you know the period, which was last week, you're now trying to find the range. Let us find it. Let me show you how to find the range. We have to highlight first. Let me highlight what happened last week to make it simple for you. Now, this was what happened last week as far as gold is concerned. So this was what happened last week. The highlighted area. So what was the highest level this market went last week? Here, that was the highest price gold traded. What was the lowest price? It is down here. Now, what happened this week? How could you have traded gold this week? Look at something. This week, when the market opened, gold traded below, and the trend from the bigger time frames was bearish until it traded into a support, some form of a support level. Even me, long term, I think gold is bearish. I think you still have some selling to do before it gets to some level that looks like a nice area for a support where we can buy. So if you look at what is happening on the bigger time frame, you can clearly tell that gold is what has been bearish for quite some time. You see how it's slanting bearish. When the market opened this week, this was a range for the previous week. How could you have entered gold to sell it? There are two things you could have done. It is either the market would have traded back to the previous week's high, which is acting as resistance. So we sell from there like this. Something like this. Or it trades below the previous week's low to act as like this. This was what happened. It traded below the previous week's low and then went back up for a retest. This was a retest. This bullish candlestick was a retest. So after that retest, you could have entered your trade right there because that is a support level that is broken. Once a support level is broken and retested, it is no longer a support level. It becomes what? A resistance level. So this is where we could have sold good at this very level down here. And assuming you did that, how many pips would you have made on this trade? 383 pips. When you look at the middle figure, you see 3839. So it's actually 383.9. There's a point between the last 3 and the 9. So that is 389 pips you could have made on this trade just by waiting for it to break below last week's low, which was acting as support, and come back to retest it. Then you enter the trade upon the retest. So that's how important highs and lows are. They act as support and resistance levels. Let's look at a few more examples. I'm looking for very, very good examples that I can show. Now let's come back to this week. That was between 18th and the, when was this? Let me place horizontal line. Let me place horizontal lines. This is the period I'm referring to. What happened that week? What was the range that week? Okay, this was the lowest it traded that week, all the way here, and it was the highest it went, all the way here. So where's our range for that week? Where's our support and our resistance? Remember, the highs and lows are acting as support and what? Resistance. What was the high for that week? Right here. Let me do the highlights before I place the horizontal line there. That was the highest it traveled or it traded that week. So we placed a horizontal line right there. And this was the lowest. Now look at what happened the following week. Look at the following week. After the market traded up into that high, it sold, and the selling even entered into the week after. So this was where it got rejected at, after it traded into the resistance level from that week. And look at how long it sold for, all the way from there down to this level. How many pips? Let's calculate. So assuming you caught this trade here and you're able to hold it up to this level, that is 899 pips, almost 900 pips. Almost 900 pips on gold. You get me? So this is what I'm talking about. When the trading week begins, it's always good. If you want to trade a particular pair, it's always good that you find the trading rate from the previous week. If you find a trading rate from the previous week, that is after you already know what the general trend is. It gives you a very good perspective, and it gives you the levels you should